It is pretty tough out there. We've had home prices spike by huge amounts in the last 2 years, and in some cities by 50 and 60% in a 2-year time span. And when mortgage rates were 3%, now mortgage rates are at over 7%. So the equation doesn't work out anymore. And the housing market is sort of reacting very rapidly to these much higher interest rates. It just doesn't work. It just does not work to have these kinds of home prices with 7% mortgage rates. And they have to adjust, and the interest rates are not coming down. So it's going to be the house prices that have to come down to make this market work again. Yeah, so there's really two separate things you mentioned here. So one is the Fed put, and the Fed is now laser focused on inflation. And inflation is turning into a huge mess. Last year sometime, and we talked about it a little bit, and at that point, I said that 4% CPI inflation was baked in. I was one of the radicals out there, and I completely underestimated where this would go. And now we're at 8%, and it's underlying inflation that's coming up. The Fed's been pointing it out. I've been saying it for many, many months. It's in services. That's 2/3 of the consumer economy. That's where inflation is now. It's no longer really in goods and commodities. So this has changed the equation. This was not transitory. This inflation has now spread across the economy, and services inflation is over 7% now, and it's just shooting straight up. And so the Fed acknowledged that, and it's focused on it. And the last Fed meeting, at every Fed meeting, they get more hawkish. And they did so again in the last meeting, and they acknowledged that house prices are going down, and Powell essentially said, yeah, they need to go down. They have spiked so much that the housing market went completely crazy. Yeah, that can't go on, and so you've had this kind of dramatic surge in inflation, and the Fed acknowledging that is the number one problem, and acknowledging that home prices had gone wild. And so, when home prices go down, the Fed's not going to lower interest rates, not going to buy mortgage-backed securities, because it's focused on inflation. And this inflation isn't going away. I mean, this is going to get bad, and next year it's not going to be suddenly settling down. And so the Fed put is based on the ability of the Fed to jump into the markets with lower interest rates and maybe QE, to support asset prices. And now the Fed cannot do that because it is focused on getting this inflation under control. And if the Fed tried to lower interest rates now and restart QE, we would really veer into hyperinflation. And the Fed cannot do that. So that's off. The Fed is off, and asset prices have to find their own way. And markets are pretty good about figuring out how to do that. It gets a little rough sometimes, but generally, markets are good at figuring out what prices should be. And so now you have the other situation in that the Fed is no longer required to bail out the housing market because the banks are no longer on the hook, as you said. The banks have since the financial crisis sold most of their mortgages to entities that convert them into mortgage-backed securities. And the qualifying loans, they have been sold to Fannie Mae and Freddie Mac and all the other government-sponsored enterprises and government agencies. So they're taxpayer guaranteed. And the loans that didn't qualify for being bought by Fannie Mae and Freddie Mac, they were sold to private entities and converted to mortgage-backed securities. So we have these private label mortgage-backed securities. We have the government-backed mortgage-backed securities, and all of them are owned by investors. So they're owned by pension funds, they're owned by insurance companies, they're owned by bond funds, they're owned by global institutions. A bunch of them are owned by the Fed and maybe other central banks. So when these mortgages go back, and we're far from it. I mean, these mortgages are really good. We are just coming out in terms of the foreclosures and defaults. We're just coming up from the record low levels during the pandemic. So there really is not any kind of major issue on the horizon at this point, but there may be sometime in the future. And when that happens, it's investors and taxpayers that are going to be on the hook for this, and not the banks. The banks have very small mortgage exposure. I mean, they have some exposure because while they're waiting to accumulate enough mortgages to have them rolled into mortgage-backed securities, they're exposed to these mortgages. And some of the non-bank lenders do that, like Rocket Mortgage. They can get caught up in this, and they've lost a lot of money because of it. But in terms of being on the hook when credit goes bad, that's not the banks anymore. It's the taxpayer and its investors. That was the reason they bought mortgage-backed securities and did QE last time. One of the reasons, because the banking system was collapsing under the strain of these mortgage-backed securities and mortgages that they were holding, and not really the mortgage-backed securities, but the mortgages. And you know, it's not that the banks would have collapsed. It's that the investment banks had leveraged bets on this stuff, and like Lehman and others, you know, and it's not necessarily that Wells Fargo would have collapsed, or Bank of America or JP Morgan. It's that the big investment banks got in trouble with this stuff, and the other banks were just taking big losses. And we've had you know, a situation where people started doubting in the health of the financial system. And so, and in a fiat financial system, you need confidence. And that's what it's based on. You know, when you lose confidence in the financial system, then you can get all kinds of problems. And that's what we started to get during the financial crisis. That's what a financial crisis is all about, really, to some extent. It's a loss of confidence in the banking system. And so the Fed stepped in part to deal with that. And that's not an issue anymore. So the Fed doesn't have to do this anymore. And it won't be able to do it because there's too big of an inflation problem. And the banks will be just fine. You know, you may have some of the non-banks, some of the shadow banks fold. You know, they're already penny stocks, and but they don't take deposits. So the problem with the banking system is that they take deposits. There's $17 trillion in the deposits in the banking system. So when the banking system gets in trouble, you're thinking about the deposits. But the shadow banks, they don't take deposits. They fund their mortgages in other ways, and so that's not really an issue for the Fed. The Fed doesn't regulate them anyway. So yeah, I don't see any reason for the Fed to step in here. I mean, the Fed can let this correct and find the natural level where home prices should be, and the market will be fine. You've got lots of inflation, and you know, wages are going up. And so, I mean, there will be a natural bottom somewhere in this house price decline. Interest rates, mortgage rates are directly related to home prices. That has been well established over time. And in the normal range, it's not such a huge difference. You know, when mortgage rates fluctuate with the rate of inflation, you know, you have that. So you have high periods of high inflation, you're going to have high mortgage rates, you know, and you have periods of low inflation, you're going to have lower mortgage rates. And that used to be the case before the Fed started really getting into interest rate repression. And so now we've had, you know, 3% mortgage rates, below 3% mortgage rates. And for the last 2 years, and yeah, so that added another 50, 60% price increase on top of the already big price increases before. And, you know, coming out of the dot-com bust in 2000, 2001, 2002, you know, the Greenspan Fed, so the Fed led by Alan Greenspan back then, lowered interest rates because the stock market implosion was causing a downturn in consumption, and you know, the tech bust especially, and you know, a lot of jobs got decimated, high-paying jobs got decimated, and that, and so to get out of that, the Fed back then decided to create a housing bubble to get over the dot-com bubble bust, and so we got the first surge in home price, unnatural surge in home price within a couple of years. Home prices just shot up, and that imploded when the Fed saw that and started raising interest rates. And so then we got the housing bust out of that. So then we do it all over again in 2008, 2009. It took housing 4 years after the Fed stepped in before it actually started going back up. I mean, it kept crashing despite QE and despite record low mortgage rates at that time. And so now we've got another and the most ridiculous spike ever. And and mortgage rates are higher than they were 20 years ago. And, it doesn't take a genius to figure out where this is going. And that's just how it is.